Panic selling energy right now is the wrong trade, and the rotation already happening tells you exactly where to look instead. QQQ is up 8.08% in 1 month, double SPY's 4.44% gain. That gap tells you where institutional money is flowing. This isn't broad market strength. It's concentrated. AI infrastructure is driving nearly all S&P 500 gains, while earnings growth outside that theme is running at 0%. The move is specific. So is the opportunity. Oil is down on U.S.-Iran nuclear deal expectations. That's a supply increase, not weakening demand. The distinction changes everything about how you position. When supply drives an oil sell-off, energy input costs fall for consumers and industrial users without a corresponding drop in economic activity. That is not a market problem. It is a reallocation signal. The historical parallel is specific. In Q4 2014, Brent crude fell from $115 to $55, a 52% collapse driven by OPEC flooding supply. In that same 6-month window, the XAL Airline Index gained over 35%. The Dow Jones Transportation Average gained roughly 25%, while the energy sector lost over 20%. Fuel is the single largest operating cost for carriers. When it craters, margins expand directly and immediately. That is a mechanical relationship, not a coincidence of timing. After the 1991 Gulf War ceasefire, airline margins expanded by an average of 4 to 6 percentage points within 2 quarters as jet fuel costs normalized. The structural analog is consistent across cycles. Now the valuation context. SPY trades at 28 times, trailing earnings with dividend yields at all-time lows going back to the 1800s. Before the 2022 drawdown, SPY peaked at approximately the same multiple. What followed was a decline from $479 to $342, a 29% drop. The mechanism was simple. Elevated multiples met a demand shock and compression happened fast. The critical difference today is that in 2022, earnings outside a few sectors were still growing. Right now they are not. A 28x multiple on flat earnings is not a value proposition. It is a crowded bet on a single theme continuing to deliver. FJET appeared in the same headline as QQQ during the week. SPY recorded its best weekly rally since 2023. The catalyst cited was U.S.-Iran peace progress. Lower geopolitical risk means lower oil risk premium, which means lower jet fuel costs, which means wider airline margins. The market is already pricing the rotation. Consumer discretionary and transport components of the index carry substantially lower multiples than the broad market. If earnings expand on fuel cost relief, those sectors re-rate faster and from a lower base. Now the counter-argument, and it deserves full weight. Iran deal negotiations have failed before, repeatedly. Talks collapsed in 2022 after 18 months. If that happens again, crude snaps back and the rotation into airlines and consumer names unwinds fast. That is not a tail risk. It is a documented pattern. The bull case on XOM and CVX is more durable than the bear framing suggests. Exxon's forward PE sits at 14.87, half the broad market multiple, and the company generated $28.84 billion in net income in 2025 on a gross margin of nearly 30%. That is not a business in distress. It is a business being priced like one. Chevron's dividend yield provides a cash return floor that pure growth names cannot match, and at a $270 billion market cap, institutional exits are not fast or clean. Zome's $642 billion market cap makes it one of the most liquid large-cap names in the world. Forced selling takes time, and that time creates opportunity for patient holders. A supply-driven oil decline that turns into a demand signal would hit both sides of this trade simultaneously. Operational leverage cuts both ways. Position sizing matters more than the thesis right now. My position: I am not adding broad index exposure at these levels. I am watching airlines and logistics names with direct jet fuel cost exposure on their income statements. If the ceasefire holds past 30 days, those margin relief trades become structural, not tactical. Are you rotating out of energy into airlines here, or staying in energy through the commodity risk? Drop it in the comments. The trade is underneath SPY and QQQ, not in them. The question is not whether the market is moving. The question is whether you are in the part of it that is actually moving.